Welcome to the Rothkoff Law Group podcast, Elder Care Uncovered. If you are anywhere near the world of long-term care for a loved one, you know the cost of assisted living facilities, or ALFs, can be, well, just staggering.
It's true, and that naturally leads to one of the most common and, frankly, one of the most complicated questions we get, especially around tax season.
Can I deduct the cost of assisted living?
That's the one. And you look at the IRS code and, deducting the cost of a nursing home is usually pretty clear-cut. It's almost always seen as necessary medical care.
Right.
But ALFs are different. They're structured to mix medical support with, housing and social activities. And that's where the tax rules get very, very muddy.
Exactly. So our mission today is a real deep dive into those precise IRS regulations. We want to give you the shortcut to understanding the complex criteria that can turn a huge, non-deductible expense into a potentially 100% deductible medical expense. We're going to show you how to navigate the paperwork and really figure out if you qualify.
And we're going to focus on the specific legal language the IRS uses for qualified long-term care costs. That's the key distinction. If the services meet that definition, the cost of assisted living suddenly moves from being just a personal expense to a medical one.
And that opens up enormous tax relief. Okay, so let's unpack this core concept. To get that full deduction, the ALF resident has to qualify as a, quote, chronically ill individual. That's very specific IRS language.
It's incredibly specific. And what's interesting is how it's designed to draw a line. It's distinguishing between needing some help because you're aging versus needing help because you require genuine, certifiable long-term care.
So it's not just about being in an ALF.
Not at all. Qualified costs have to be necessary rehabilitative services, maintenance, or personal care services that are, and here are the two big conditions. 1, required by a chronically ill individual, and 2, provided pursuant to a plan of care by a licensed healthcare practitioner.
So that chronically ill definition is this gateway to everything else. How does a practitioner, a doctor or a nurse, actually certify that? What are the tests?
They have to meet one of two key requirements. And this is critical. That certification has to be current. It has to have been done within the preceding 12 months by a licensed healthcare provider.
Okay, so what's the first test?
The first one is all about functional capacity. It focuses on the activities of daily living, or what everyone calls ADLs.
Right.
The resident has to be unable to perform at least 2 of the 6 listed ADLs without substantial assistance from another person.
And it can't just be for a short period, right?
Yeah.
There's a time component.
There is, and it's a hard line. This loss of functional capacity has to have lasted or be expected to last for a period of at least 90 days.
90 days. Okay, so for everyone listening, those 6 ADLs the IRS looks at are eating, toileting, transferring, so like moving from a bed to a chair, bathing, dressing, incontinence. So if your loved one needs substantial help with, say, just dressing and transferring, they hit that 2 ADL requirement.
That's correct. You can think of the 2 ADL rule as the physical test.
So here's a practical question, though. What if the resident gets admitted, the doctor certifies they need help with 2 ADLs for the next 90 days, but then, 60 days in, they have a great recovery and the assistance level drops?
That's a great question.
Is the deduction for the whole year gone because they didn't meet the full 90 days?
It raises a really important point about the wording of the certification itself. The document must state that the condition has lasted or is expected to last for 90 days.
So it's about the expectation.
Exactly. If the practitioner writes down that the loss of capacity is expected to last for 3 months or more, that piece of paper satisfies the 90-day requirement. Even if the person unexpectedly recovers a bit earlier, it's all based on the professional assessment at that moment in time.
That's really helpful context. Okay, so what's the second way to qualify? The one about cognitive issues.
The second test covers severe cognitive impairment. For this one, the resident must require substantial supervision, and the key reason is for their own protection from threats to their health and safety.
So that sounds like it's designed to cover conditions like Alzheimer's or other forms of dementia.
Precisely.
The main service the ALF is providing in that case isn't just help with, putting on a shirt. It's constant oversight to prevent wandering or accidents or other dangers that come from that cognitive decline.
That's it exactly. And in the eyes of the tax code, that supervision, because it's necessary for health and safety, is considered a deductible personal care service.
So if you meet either the 2ADL test or this cognitive impairment test, it's all properly certified, You've opened the gateway.
You've opened the gateway. The ALF expense can now be treated as a qualified long-term care cost.
Okay, so once you meet the functional criteria, we get to the IRS's favorite part, which is, of course, the paperwork. Securing that certification usually happens during a really stressful admission process. What does a caregiver need to make sure they walk away with?
You really have to be strategic here, right up front. The most crucial piece of paper is the written opinion. It has to come from a licensed care practitioner who has personally examined the resident.
A personal examination. So it can't just be a file review or a phone call.
No, it must be a physical, in-person exam. And that's really key, especially if you're using, say, an outside primary care doctor instead of the ALF's on-staff physician.
And who qualifies as this certifying practitioner? Is it just doctors?
It's actually defined pretty broadly, which is helpful. Any physician, a registered professional nurse, or a licensed social worker can provide the certification.
Oh, a social worker too. That's interesting.
Yeah, and we often see social workers involved because, frankly, they're experts at assessing functional capacity and the need for supervision. It's a big part of what they do.
And what about the timing of all this? Is it better to get this documentation before the move even happens?
Oh, absolutely. The certification has to be current from within the last 12 months. So ideally, you want that opinion in your hands before or immediately upon admission.
Right.
Just imagine trying to chase down a specific retrospective tax document months down the road while you're focused on care. It's a nightmare. Securing it early just streamlines everything.
So the second piece of documentation is this plan of care. You mentioned the Internal Revenue Code is surprisingly kind of ambiguous about what this plan needs to look like.
Yes.
If the IRS doesn't define it, what should you be looking for from the ALF to make sure you satisfy this requirement?
It's a fascinating gray area, and it means the taxpayer has to be smart. ALFs don't have federal mandates for these plans like nursing homes do, but the plan has to clearly show a connection. It needs to be prepared by a licensed care practitioner, again, a physician, nurse, or social worker at or very soon after admission.
So what should be in it?
Because the code is vague, the plan needs to clearly spell out two things. One, the specific chronic condition that was certified in that written opinion. And two, how the services the ALF is providing, the personal care, the maintenance, the supervision, are directly related to that certified condition.
So you need more than just a generalized activity schedule.
So much more.
If the certification says your mom needs help with 2 ADLs, like dressing and transferring, the plan of care should detail the specific services that help with those two things.
Yes. Dressing assistance at 8 a.m., transferring assistance for meals, things like that. You need that paper trail connecting the medical need directly to the service being delivered.
That's the difference between just a care schedule and a piece of paper that will satisfy an IRS auditor.
That's it. It shows the services are provided pursuant to a plan.
All right, let's talk about the money. This is where the rubber meets the road. If you've successfully navigated all of this, the chronic illness is certified, the ADL or cognitive test is met, the plan of care is in place, what is the absolute best case scenario for deductions?
The best case scenario is really the gold standard here. It's the 100% deduction. If all those strict IRS requirements are met, 100% of the ALF costs are deductible.
100%.
And depending on the annual cost of the facility, that can easily be a 6-figure deduction.
And here's the part that I think always surprises people, the thing that makes this deduction so powerful. The 100% deduction includes room and board costs.
It does.
Why? Why does the IRS allow you to deduct what is essentially rent in this specific situation?
If you think about the logic, the IRS recognizes that for a person who is certified as chronically ill and is receiving these qualified services, the housing is inseparable from the care.
You can't get one without the other.
You can't. You can't receive that dressing assistance or that substantial supervision without living there.
Oh.
So the room and board are considered part of the medical service itself. Unlike, say, a typical hospital stay where you can usually only deduct the direct medical care, this is just huge.
It's a critical insight.
Yeah.
But even with a 100% deduction, you still have to clear that hurdle that applies to all medical expenses, right? The adjusted gross income threshold.
Absolutely. We have to get into the nitty-gritty for a second.
Let's do it.
You can only claim an itemized deduction for your unreimbursed medical expenses, which now includes these ALF costs, to the extent they go over a certain floor. For 2023 taxes, that floor is 7.5% of your adjusted gross income, or AGI.
Okay, so can you give us an example?
Sure. Think of it like a deductible on your car insurance. If your AGI is $100,000, 7.5% of that is $7,500.
Right.
You only start deducting the medical costs that pile up over that $7,500 mark. So all your qualified expenses, the ALF costs, your insurance premiums, prescriptions, they all have to clear that floor before you see a tax benefit.
But the good news here is that ALF costs are typically so high that they clear that 7.5% floor pretty quickly.
Very, very quickly. It's usually not an issue.
That clarifies the full deduction pathway. But what if, for whatever reason, maybe a chaotic admission and oversight, you don't have that strict initial certification of chronic illness? Is all tax relief just lost?
No, not necessarily. There is an alternative path, which is a partial deduction. If the resident doesn't meet that strict IRS definition for being certified as chronically ill, you can still deduct the percentage of the ALF costs that are specifically for nursing services.
Okay, so in this partial scenario, all the personal expenses, the room and board, entertainment, laundry, all that is not deductible.
Correct.
Only the actual medical component is. So what's the practical reality of that? How do you figure out what that percentage is?
That's where you have to be proactive with the ALF's administration. The facility should provide an estimate of this deductible portion to you every year. Usually it comes on a statement or some kind of year-end summary.
But what if they don't? What if the ALF is just not forthcoming?
Yeah.
Or they say they don't provide that kind of estimate? What's your recourse then?
Well, if the ALF is being uncooperative, you should ask for a breakdown of their cost structure. They often have one for insurance billing or state reporting, and that will itemize the nursing costs.
And if that fails?
If that fails, you can fall back on general industry averages. We typically see about 30 or 40% of the total ALF cost being for nursing services, and that would be your potentially deductible amount.
So 30 to 40%.
It's a common range. Now, you should always try to confirm this with the facility or a tax professional, but that's a good ballpark.
That knowledge is invaluable. Because while 30 or 40% is definitely better than nothing, it really underscores why getting that written certification up front, the one documenting the ADLs, the cognitive impairment, is so important.
It's the difference between a few $1,000s in deductions and potentially deducting the entire annual cost. So, to summarize it all, you really have two different paths here. You've got the full deduction, which you get if you meet those strict chronic illness criteria and have it all certified.
Right, that's the one that lets you count 100% of the costs, including room and board.
And then you have the partial deduction. That's your backup plan. It lets you claim just the percentage of the costs for nursing services, which is usually, 30 to 40%.
And understanding that the real linchpin, the thing that unlocks that full deduction, is securing the specific documentation, that certification of the two ADLs, or the cognitive impairment, and the plan of care.
It completely transforms your financial outlook for long-term care. And since we've established that the documentation of chronic illness has to be secured and certified within the 12 months prior to or right at admission, this raises a final important question for you to think about year after year. As your loved one's condition changes, how crucial is it to review and update that certification annually? Making sure that document stays current is really the key to maintaining your eligibility for these huge tax deductions as you move forward. Thank you for tuning in to Elder Care Uncovered.
And remember, the Rothkoff Law Group assists our clients with finding, receiving, and paying for quality long-term care. Should you have any additional questions about navigating these complex planning and financial issues, you can reach out to the Rothkoff Law Group team with locations throughout the Philadelphia and Southern New Jersey region. We'll see you next time on Elder Care Uncovered.